Hello, good evening all of you. So in this short lecture, I'll share how the financial management field has been evolved over a period of past 100 years. There are three phases how the financial management has been changed. So the first phase is traditional phase, which is from 1900 to 1940. That is the beginning of the 20th century. The transitional phase is a short span of around 1940 to 1950 or 1960. There is no clarity whether it is 1940 to 1950 or 1940 to 1970, but somehow in between 1940. Okay, and the modern phase, what we are facing today. So these are the three phases how the financial management has been changed, and what is the focus on each phase. What is the focus during each phase? So earlier, during the traditional phase, financial management used to focus only on occasional events. So I mean to say occasional events in the sense only mergers, acquisitions, or purchase of capital assets, purchase of machinery, etc. Only occasionally when they want to open a new factory or when they want to enter a new business, only occasionally people used to give importance to the financial management, not regularly, not on a recurring basis. During the traditional phase, the financial management is used only and occasionally, not on a day-to-day activities. So the scope is only on long-term activities. During the traditional phase, the financial management focus is only on long-term activities. And most important is that earlier financial managers has been called upon to analyze whether our proposed project will be able to repay the bank loan or not. So more focus is on outsiders, that is to say lenders. So during the traditional phase, financial managers has been called upon by the entrepreneurs to analyze whether the project will be able to repay the bank loan or not, whether the project will be able to repay the borrowed money. Therefore, main emphasis of the financial managers is on outsiders. Okay, and beneficiaries are mostly corporates. Beneficiaries are only mostly corporates. Now, transitional phase, a short span. So now during the transitional phase, financial management has used it regularly, not only occasional events, but also day-to-day working capital management. So during the transitional phase, financial management has given importance not only to the occasional events like mergers or capital asset purchase decisions. So during the transitional phase, emphasis is also on the working capital decisions also. So it is in the transitional phase where we have started giving importance to the working capital management. Okay, during the transitional phase, we have given importance to the working capital management. Next scope, that is to say both long-term decisions, medium-term decisions, and short-term decisions. We are giving importance to all the three frequencies. Emphasis on shareholders. Now the emphasis is on shareholders, not only the outsiders, but also the shareholders also. Ultimately, end of the day, we have to justify the equity shareholders return. So emphasis is more on the shareholders. So financial managers have started analyzing the impact on the shareholders. Financial managers have started analyzing the impact on shareholders and beneficiaries of corporates. During the modern phase, so same thing will occur, recurring long-term, short-term decisions. Now the more importance is on stakeholders, not only the shareholders. Gone are the days used to focus only on the lenders or the equity shareholders. Now we have to focus on stakeholders. What is the impact of every decision on the employees, on the customers, suppliers, creditors, government, local community, everything. So now we have to focus more on stakeholders, not just shareholders. And we are using the financial management not only in corporates, even SMEs, non-corporate entities also, we have started using the financial management. Okay, so the emphasis is now more on stakeholders and also on corporates and non-corporates. So this gives wider scope to the finance field. This gives wider scope to the finance field. You are not expected to work only for the big MNCs. Your role is there, your need is there even for small SMEs also. Okay, so our need is not only for the MNCs, our need is there even for small companies, MSMEs also. That is where you have to recognize the opportunities. We should not look after only the crazy jobs or rosy picture of MNC career. No, our need is there even for small entities also, small or medium entities also. Our need is there. We should not hesitate to work for small entities. Whether you are preferring employment or whether you are preferring practice, we should not hesitate to work for the small entities. Okay, our need is there even in non-corporates also, even in small entities also. This is how the financial management has been evolved over a period of time. So now I would like to give the SWOT analysis of the finance field. SWOT analysis. So first I'll focus on the weakness, threats, then strengths and opportunities. Okay. So first we have to focus on the weakness. Forget about outside world. So what is internally we are weak, what we are not comfortable with, what we are not comfortable with. Okay, not recognizing how crucial it is to have reasonable knowledge on other operations. So this is aversion or unwillingness of the finance professionals nowadays to learn the other fields. Unwillingness of the finance professionals to learn the other fields. That is the major drawback. Look at that, how the kid is crying to eat the food. Similarly, if you observe the mindset of the CA students, when they read the information technology subject, their facial expression will be like that only. Okay, when the faculty used to enlighten the information technology subject, that is how the facial expressions will be. They are reluctant to learn the other subjects, most especially technology, engineering, anything. Okay, that is the first important. Our weakness is that we are not comfortable with the field, where we are not comfortable to learn the knowledge of the other fields. We thought that learning financial knowledge is enough. Having deep expertise in financial knowledge is enough. No. So jock in all, master in one is gone are the days. So you have to be jock in all, master in one. Jock in all, master in one. So you should have a reasonable knowledge in all the subjects, and also you should have a in-depth knowledge in one subject. No doubt, we have an in-depth knowledge in one subject called as finance. But it is very important to have a reasonable knowledge in all the fields: technology, manufacturing, engineering, any other field. Every field we should have a reasonable knowledge. That is a weakness. We have to overcome that weakness. We have to come out of our comfort zone, and we have to enter the courage zone, and we should have an open mind to learn the other knowledge. Don't say that it is not out of my job. It's not my cup of tea. No, everything is your cup of tea. You are supposed to know the knowledge of other fields also. That is first point. And threats, most important, automation. There is one US agency recently, I think not recently, 4 or 5 months back, I read one research report given by one of the US research agencies, which says that it is the finance field which will be affected more by automation rather than any other field. It is the accounting and finance field which will be affected more by the automation. So therefore, we should be very cautious. So most of the financial jobs will be entry-level financial jobs, or accounting jobs will be lost because of the technology. So therefore, automation is the biggest threat to our field, finance field. So most of our basic functions will be done by the computer, software programs, etc. So we need to have an in-depth knowledge. Okay, so basic knowledge is not at all sufficient to survive. Forgot about the growth. Basic knowledge is not sufficient even to survive also. That is the biggest threat for us, is the automation. And next, so if gone, drawbacks are gone, weakness and threats, focus on the strengths. So what is our strength? Ability to analyze how every decision impacts on the profits. What is the impact of every decision on a profit? Any decision. So installing a new machinery, or going for the media advertisement, or going for print media, electronic media advertisement, digital advertisement, anything. Every decision we can analyze the impact. So what is the impact of this decision on my profit? How much cost will be involved? How much revenue I can generate? So we have that ability to analyze the impact of every decision on profit. End of the day, our end of the day, that's why it is called the bottom line. Bottom line means end of the day, our ultimate object is profits. So how every decision impacts the profits, we have the ability to analyze. That is our strength. And opportunities, when it comes to the opportunities, every department depends on the finance. Every department depends on the finance. Ultimately, for the resources, they will depend on the finance department. And ultimately, when they have to justify their operations, they have to justify in terms of financial impact only. That is what the important point. Okay, a sales manager cannot simply say that I brought 1,000 new customers. It's of no use. How much sales revenue is generated out of 1,000 customers? How much profit is generated by 1,000 customers? If you are giving the 50% discount or 80% discount, I can get 1,000 customers. So what is there if they are making any small amount of sales? No, it is not just sufficient for a sales manager to portray that he brought 1,000 new customers. So what is the impact of that? How you got the 1,000 customers? What is the financial impact? What is in it for me if I got 1,000 customers? Therefore, every department, end of the day, they will come to the finance department and analyze, this is what I have done, how I can justify my operations to the board of directors. Okay, or how I can justify my operations to the management. Ultimately, we have to show the financial impact of that. Okay, so this is our opportunity. Once we overcome our weakness or threats, definitely we have a field. So if you start neglecting the first two things, weakness or threats, we are going to see huge unemployment in the finance field. That is a very dangerous thing. So in order to prevent that, in order to overcome the automation, in order to overcome the negative impact of the automation on the finance field, so we should learn all other fields, and we should have an in-depth knowledge. So two basic conclusions: have a reasonable knowledge in all the fields, and also understand every subject in detail, not just basic knowledge or moderate knowledge or working knowledge. So no, in-depth knowledge, what a machine cannot do. A machine can do basic functions. We should do more than what a machine can do. Then only there is a need for the finance professional. Okay.